This is Dudediligence here, and today we're going to talk about something that we sort of talked about 2 months ago, but we never really sort of do a follow-up on the cost of shorting and the cost of long in the market. So a little bit of context of how this video is going to be structured. So basically there are two market forces in the entire market, right? We all know that there are people who are going long, which is people who are speculating or betting on that the entire Nasdaq index or all indexes or stocks have a upward momentum instead of a downward momentum. And you have people who are shorting the stock where, for various reasons, for example, if you think the fundamental value of the stock is overvalued, therefore you will short it for a period of time. And until the stock goes to that point, you sort of neutralize your short position, aka covering it. And then, you sort of like catch it with a long position or something like that. And there's a way to check how much does it cost to short and how much does it cost to long. And usually the long side will have the edge and the short side will have not an edge, because for most of the time the stock market actually goes up more than it goes down, right? If like what we posted earlier in this year that we talk about, there's 60% edge on the long side and there's 40% sort of like a not really edge. So basically, if you're betting that the stock market is going up in a long-term period of time, you will probably have a 20% edge over the people who are shorting it. But during specific time frames or time period like what we are right now with the war, with energy price, with inflation, with we have an incompetent administration and we have an incompetent team of policy making, and we have a lot of people who doesn't want to work, we have a lot of issues in the American society, the cost of short, so generally speaking, normally the cost of shorting is actually lower than the cost of longing. Because think about this, right? You probably will make more money to long the stock rather than shorting the stocks. Therefore, it probably will cost you more to long the stock than cost you to short the stock. But if we look at the SQQQ and TQQQ, they're basically 2-3x leveraged ETF that you can do to either long the Nasdaq or short the Nasdaq, right? So if you're buying into SQQQ, what it means is every 1 point decrease, every 1% decrease in Nasdaq, you will have 3% increase in your holdings of SQQQ. And contrarily, if you buy into TQQQ, that means every 1 point increase in Nasdaq, you will make 3% in TQQQ earnings. But here's the interesting part. Usually what happens is TQQQ's price will be 2 times or 1.2 times more than SQQQ. But if you look at the price of SQQQ and TQQQ right now, they have very similar pricing. And as we all know, retail investors always lose money and institutional investors always win money. But the reason why institutional win is not because they trade on average better than the retail investors, but because the method of their trading is better than the retail investors. What do I mean by that? Majority of the revenue produced or made by the institutional investors are actually in the process of market making, which means they push a product, they push a stock out, they become the market maker of the stock, and then when retail and institutions start buying or selling those stocks, they sort of make a flat percentage or flat amount based on the volume of the stock. So in this case, when ProShare, which is a market maker or which is an institution, they push out the ETF that give you leverage to short or long Nasdaq, what they have to consider is the price of them become the market maker of providing you the service to short or long the stock. And when TQQQ and SQQQ have the same price on the market, that means that the cost of shorting and longing the Nasdaq is essentially the same. What does that mean? That means the market is A, very uncertain, and B, we expect a huge volatile market in the coming month or coming week. So let's put that into perspective. What do you mean by a huge volatile market? That means you will see a big ups and big downs, but the general average the average index value would be stuck in sort of like a range. So we did the range analysis before, right? We talked about the upward bound of Nasdaq is 14,500 and the lower bound would be 12,800. So in this case, our lower bound is a little bit overestimating the volatility of the market. But if you see the general trending, how the trend line moves in the Nasdaq, you will realize that in the next month or so, especially leading towards the next FOMC meeting, the Nasdaq index value is actually bounded by 13,500 and 12,500. That means no matter what you do, what kind of spread you do in terms of options or in terms of just holding stocks, you will probably expect the stock to not exceed 13,500 and lower than 12,500, right? Or what will happen is it's just gonna move in between those bounds, but most likely, our prediction is most likely it will go under 12,500. They will go under the bound, and we will see a further drawback on the Nasdaq to at least 12,300. And then when it reaches 12,300 line, it will probably go bounce back up again. Okay, but generally speaking, the trend is we will see volatility within this range. We will see huge volatility within this range, but generally speaking, the market will still go down until it reaches a equilibrium point, which is probably not going to be until about March 25th-ish, the week of March 25th. And then we sort of will see a turnover point or potential turnover point leading towards April. Okay, and for those of you who are interested in energy prices, I will make another video on oil. And of course, I promised you guys the MMAT video, and I will make that accordingly afterwards. See you guys down the upside, and hopefully this video is helpful. And if you like this video, smash the like button. If you have any questions, ask away in the comment section. And we are not financial advisors. We do not give financial advice. Therefore, everything we say on this channel is for shits and giggles. See you on the upside.